As we all know that there are two approaches to analyze a stock. One is fundamental analysis and another is technical analysis. In fundamental analysis, we analyze the economy. We analyze what all macroeconomic factors are there in the economy and how they are impacting the stock market overall. Then we go by analyzing the industry. Whatsoever share we are interested in purchasing belongs to a particular industry group. So we analyze the potential of that very industry. And finally, we analyze the company. In company analysis, we analyze all the fundamental factors which are there in the financial statements of the company, be it profit and loss account or balance sheet. We analyze all those factors and we try to reach to some conclusion that the shares we are going to invest in is worth investment or not. So this was fundamental analysis. Quite opposite to this is technical analysis. So today's presentation will be based upon technical analysis. Let me open the PPT. Now, what happens in technical analysis? In technical analysis, we do not take any such factor, be it economy, industry, or company specific factors. We only take past prices of a particular stock and its past volume. And with the help of that very information, be it prices or volume, we try to make a trend in graphs or charts, and we just see that what the stock is going to do in future and what potential it is going to have in future, whether this will rise in future or this is going to fall in future. So we can see that it is the study of market action primarily through use of charts for the purpose of forecasting future price trends. So merely just two kind of information are taken. This is past prices and the market volume. Now, this technical analysis is based upon certain assumptions. The major assumptions are: first is market discount everything. It means that whatsoever happens in market, the stock prices reflect everything, be it good news or bad news, some positive news, optimistic news, pessimistic news. Every kind of information is reflected in the stock prices, and stock prices is the only thing that should be considered for taking our decision regarding stock market investment. Next one is price moves in trend. Now it shows that prices, stock prices are not having random behavior. Rather, they show certain pattern or some trend, be it uptrend, downtrend, sideways. Some kind of trend is formed by stock prices, and the randomness in the movement of prices is not there. Though this is not true because many studies have proved that stock market has random behavior, but for technical analysis, this point has been taken as an assumption. And next one is history tends to repeat itself. It means that whatsoever trend was formed, say a period of 4 years prior or 8 year prior, so there is a tendency that same kind of pattern would be repeated sometime in future. So the history tends to repeat itself. Now, there are various tools and techniques of technical analysis. Basically, they cover theories, charting, and select market indicators. We will be doing charting techniques in this presentation. Now, when we use technical analysis to analyze a particular share, the most important chart, the most basic and important charts formed are bar charts. They are also called as OHLC chart, which means they show four kind of information: opening price of a stock, highest price of a stock in a particular day, lowest price in that very day, and the closing price of the share. So this four kind of information is shown by the bar charts, and we make bar charts for a particular stock for every day. So you can see here that this is how a OHLC bar is formed, and you can see that if the opening price is lower than the closing price, then the chart has green color and the bar has green color. And when the opening price was higher but the market ended at a lower closing price, then this bar would have red color. So green color is a sign of bullish tendency of market, and the red color shows the bearish tendency of market. Now, when clubbed together for a number of days, the chart would look like this. So wherever green color is formed, it means the market is positive regarding future. In future, it is going to rise. So wherever red bars are formed, it means the market has bearish tendency, and this might go down further. The next chart formed is line chart. Since bar chart were taking four kind of information, line chart takes just one kind of information, that is closing price of a stock for every day. So taking the closing prices of the stock for a number of day and forming a line chart is formed and it looks like this. So simply line graph or line chart can easily show you where the market is going, whether it is following certain uptrend or it is following certain downtrend. Next, we have point and figure chart. It has basically two kind of symbol. One is X and other is O. X shows the positivity of the market. Whenever the prices are rising, this would be shown by X symbol in on the chart. And when the market starts falling, that would be shown through O symbol. So this is how this chart looks like. You can see that first the column, you can see there are three red circles which shows the market is going down. The moment it starts rising, the cursor move to the next column and it is shown by green crosses, and the crosses go on rising upward. Again, when there is a slight down is there, the cursor moves to the next column, and this is how this chart is formed. So this chart takes only the price movements into consideration and the time is not taken into the consideration. Next, and the most important chart formed and basically used by technical analysts in stock market is candlestick chart. So just like bar chart is formed, this candle, just like bars, the candles are formed, and these candles also show four kind of information. Just see, this is the candle. It shows four kind of information: high price, low price, opening price, and closing price. Similarly, similar to bar chart, when opening price is lower than the closing price, the candle would either be of green color or of white color. And when the closing price is lower and the opening price is higher, then the candle would be bearish candle and it would be either of red color or of black color. So green and white color shows the positivity of the market, the optimism in the market. Red and black color shows the pessimism or negative side of the market or bearish tendency of the market, that market is sluggish and this could go further down. So when clubbed together, these candles are formed for a particular stock for every single day. And when clubbed together for a number of days, the candlestick chart would look like this. So wherever we can see the green candles, they show a rising or uptrend in market. And wherever in the chart we can see red candles, they show the sluggish or the bearish tendency of the market. As a layman, these charts can, any user can see these charts easily on bseindia.com, nseindia.com, and moneycontrol.com. For any share, you can click on the technical analysis and you can observe different chart, bar charts, line charts, candlestick charts. Next, we have price patterns. The charts also show certain price patterns, and few of the patterns are covered in the presentation. First one is trend. Now, trend could be trend means where your stock market is going. So, trend is never a straight line going upward or downward. This is the series of peaks and troughs joined together. So, this could be either uptrend, downtrend, or sideways. So this diagram shows, so when the peaks are going further up means there is uptrended market, and when the peaks and troughs, every successive peak and trough is going down further, there is downtrend in market. And when the growth and fall of peak and trough is nearly the same, it means that there is a sideways or there is a normal trend in market. Next, we have head and shoulders pattern. This pattern is a combination of three peaks. Just that we had in uptrend, we had uptrend and downtrend. We have seen series of peak. Similarly, in head and shoulder patterns, also three peaks are there. But the thing is that first and the third peak is at nearly the same height, but the middle peak, which is called as head, it is little higher than the two peaks, and the head and shoulder patterns it formed. Now, this pattern is not showing the trend of the market, but it is showing the trend reversal in market. So whenever you observe any trend in market and at when then you see that certain head and shoulder pattern is formed. This would signal that previously uptrend was going in the market, but now this uptrend is going to reverse itself and market is going to be bearish. Market is now going to fall down. So just see, this is head and shoulder pattern. two shoulders and one higher peak, which is called as head. So wherever in price trend this head and shoulder pattern is formed, this is a big signal to the technical analyst involved in analyzing the stock market that this is the right time they should sell off their share, because thereafter the market is going to go down. Complete reverse to this is inverted head and shoulders. Again, it has two shoulders and one head, but the trough of the one head is lower than the two shoulders. So this also shows the trend reversal in market, but it shows that earlier there was downtrend in market, and after the downtrend, when this head and shoulder pattern is formed, it shows that now the market would not go down further and the market is going to rise. So whenever you see inverse head and shoulder pattern formed in the stock prices, it signals that this is the right time to purchase the share, because now the price is lower, but thereafter the prices are going to rise further. Similar to head and shoulder patterns are double tops. When two triangles are formed which are of nearly of same height, again they show trend reversal in market, which shows that uptrend was previously there in the market, but now this uptrend is going to reverse itself and downtrend is going to start. So this is the diagram which is showing two double tops. Similar to this is double bottoms. Again, it is similar to inverted head and shoulders, which shows that previously downtrend was going in market, but now this downtrend is going to end and uptrend is going to start in market. So these are two triangles, two double bottoms formed at the end of downtrend. Again, triple top, they also signal the same thing. Three triangles are formed and they are of nearly same height. It also signals that uptrend is going to reverse itself, because the market is no longer strong enough to rise further, and this might go down further. And then triple bottom also signal the same thing, that market is now powerful enough, it cannot go further down, and this is the right time the market is going to rise upwards. So whenever at the end of a downtrend, three triple bottoms are formed, three triangles are formed, it signals that market is further going to rise. And these all these charts and patterns are well analyzed, researched patterns, and historically all these patterns have proved true. Whether the market would reverse, market would go rise, would rise, market would go down, all these theories have proved true in past. And the next one is support and resistance. Support and resistance basically is a upper limit or lower limit. Whenever you observe the movement of a stock and you see that this is the upper limit of the stock, this is the maximum height the stock has ever touched, or that line is called as a resistance line. And you must have observed the lower side also, and you get to know the lower limit of a stock. This is the lowest point the stock has ever touched. So the support and resistance lines are simply the upper limit and the lower limit. So whenever the stock, when it starts rising and it's break the resistance lines, so which shows that stock market is going to be bullish further. And whenever the stock breaks its support line, so it shows that market might go down further. So these were the few of the charting patterns they are discussed here, and they are any researcher, any analyst can easily follow these patterns. And as I just said, that historically they have proven true, and a layman can easily study these patterns in the stock market easily through the site of moneycontrol.com, bseindia.com, nseindia.com, and they can take their decisions regarding stock market investments. Thank you.